Dhiraj, who's the economist and forex strategist at ANZ Research, joining in to discuss the levels that he's probably tracking for the rupee. Now, remember that the rupee is the worst performing Asian currency, or second worst performing Asian currency on a year-to-date basis. That is on a month-to-date basis in 2026 already. Dhiraj, hi. Thank you very much for taking the time out. Well, 91.5. A lot of the forex strategists were probably predicting this level, by mid or end of this year, but we're already at those levels. What's your sense in terms of what's driving this weakness, which is very sudden and severe, you would have to say?
Well, thank you very much for inviting me on the show. Look, I'm one of those strategists who were thinking that such levels would be achieved later in the year. But of course, directionally, we possibly have got it right that the rupee has a bias to weaken further. Now, technically, we are in an uncharted territory. 91.5 was our end FY27 forecast. But of course, with the current momentum, we think that 92.5, 93 could also be well within reach if the pressures remain. Now, what is leading to this weakness? I think it's a two-part answer. The first is, of course, outflows from the Indian markets have continued. Look, earnings season stress is quite visible, and also the global risk jitters around, the US-Europe tensions over Greenland and what happened in Japan. So the global cues also remain quite unsupportive of emerging market currencies, and the rupee had already been under pressure. But I think there's a bigger reason to reckon with here, and I believe this weakness had been brewing for quite some time, and it's not all of a sudden. Of course, such levels look sudden, but over the past few sessions, rupee had been gradually weakening, and I believe that is more to do with the real money flows, such as from corporate hedging demand and so on and so forth. Now, this to me is expression of the broader view that the rupee has a weakness bias, even at the current levels. Okay. Now, the bigger question is, why has the RBI not intervened? Because the last time rupee hit such levels, 91 and so on, they had come down rather heavy-handedly to bring the USD INR down. But I think since it is not to do so much with speculation, the RBI is tolerant of this rupee weakness.
Okay, so you're expecting no intervention coming in from the RBI in the next policy meet or even before that. We do have a lot of geopolitical events. We have Donald Trump who will be speaking today. So, of course, geopolitics is taking center stage. But any other domestic cues that investors should be watching out for that could impact rupee movement even further, Dhiraj?
Well, I think we're running into a rather busy time even domestically here. Of course, earnings are going on as we speak, and they have been an important cue to foreign investors who've been rather disenchanted with the India economic story, which otherwise looks quite stellar, at least on the paper. Now, what we're also seeing is that the fiscal stress is becoming a theme as we discuss, the contours of the upcoming budget and what's happening at the level of states. So I think a budget season, as is usually the case, would also be a very busy one as far as the currency is also concerned. And then we head into the RBI. We do expect that, given the kind of tightness domestic liquidity conditions are experiencing currently, it is, of course, natural for the RBI to let go of the exchange rate a little bit more so that they can refocus on domestic liquidity situation, which to our analysis has become a bit concerning.
Sure. Dhiraj, that's on rupee, but also talk to us about the bond yields, right? Now, the Japanese bond yields also are soaring over there. We saw them move higher. How should we be looking at our Indian bond yields and overall bond yields?
Well, Indian bond yields have been under pressure for quite some time for a different set of reasons and not so much global cues. And several reasons. One, of course, includes the INR weakness and expectations of further INR weakness that has kept foreign bond investors, somewhat at bay. The second reason we've been highlighting is the increasing fiscal stress in the system, given the substantial shortfall in tax revenues and the government switch from fiscal deficit targeting to debt targeting in the upcoming fiscal year. There's generally a sense that fiscal consolidation efforts at the level of the general government and not just central government are going to slow down. Of course, we have the stress in terms of states' finances also playing out in the market. The third reason is, inflation, although is currently very, very low, it is expected to rebound. And that rebound can actually be also causing some upward pressure on the bond yields. So there are multiple factors, but for India, it's largely domestic. As far as the Japanese yields go, look, it is their fiscal situation, which has, and also, investors cutting down their losing trades that has contributed to the increase in the JGB yields. fiscal situation, more so because there are plans to cut taxes and raise spending, which have raised questions about the financial management of the government finances. Now, this is actually feeding into the broader environment of risk aversion globally, or risk jitters rather. But of course, what's happening in Japan and what's happening in the US have consequences for the rest of the world. But I would believe that at least Indian yields currently are driven more by domestic factors than global.
Okay, just quickly before we let you go, this target of or maybe this target that you have of 92.5 to 93, by when or what would be possibly the key catalyst that could possibly get us to those levels, and a timeline that you might have in mind?
Well, let me clarify at first. I'm not saying 92.5, 93 is my target. Currently, our target was 91.5, but as of today, we stand corrected on those levels. So we'll have to relook at our forecasts. But my sense is that unless we see a material acceleration in some of the domestic growth indicators in nominal terms, for example, nominal GDP, and unless earnings stress abates and there's some rebound happening there, the outflow story can very well continue. And insofar as net FDI remains a bit of a weak point and current account deficit risks widening in FY27, unless there is some abatement of trade frictions with the rupee will remain very vulnerable to those outflows, and it could continue to weaken.
Take that point, Dhiraj. Thank you so much for joining in today with your thoughts at the outlook on rupee levels and what's driving the moves that we are seeing in the macro market. That's the word coming in on rupee, but we'll slip into a short break. As we do that, the countdown for Budget 2026 is underway. The most influential voices decode and analyze the impact on policy decisions from the finance minister. We bring you a power-packed lineup throughout January and on the day of the budget. Helios Capital Samir Arora for all things market, followed by JP Morgan Sajid Chinoy to discuss the macro signals. We also get you insightful analysis from industry veterans, and Dinesh Kanabar and Ashok Wadhwa for the tax rhetoric.